On October 8, 2025, a headline flashed across global markets: Riyadh accepts Yuan for oil. This unexpected announcement sent ripples through the financial world, marking a significant shift in global economic dynamics. For 50 years, oil was traded almost exclusively in US dollars, a practice that had become a cornerstone of international trade and finance. Now, the world's largest oil exporter had shattered that tradition, opting for a new path that could redefine global trade. The Saudi Ministry of Energy's calm announcement sent shockwaves through financial capitals. It was a move that many had speculated about, but few believed would actually happen. In the US, disbelief turned to alarm as the Dow plunged and the dollar index suffered its sharpest drop in a decade. The implications were vast, affecting everything from stock markets to international relations. Analysts called it a financial Pearl Harbor. The White House scrambled for a response, trying to assess the long-term impacts of this seismic shift. The foundation of American economic dominance had been cracked, not by a rival, but by a partner. This unexpected move by Saudi Arabia was a wake-up call for the US. In Beijing, the mood was triumphant. Chinese media hailed a new era of financial fairness, celebrating what they saw as a victory for their strategic patience and economic foresight. For China, this was the payoff for years of patient diplomacy and economic maneuvering. It was a testament to their growing influence on the world stage. In Europe and Asia, leaders watched with nervous anticipation, sensing a shift to a multipolar world. The balance of power was changing, and they needed to adapt quickly. The question on everyone's mind: why now? What had prompted Saudi Arabia to make such a bold move at this particular moment? Years of US-Saudi friction, China's rise as the top oil importer, and Saudi Arabia's Vision 2030 reforms all set the stage. These factors combined to create a perfect storm for change. The kingdom saw a chance to secure its future by diversifying partnerships and breaking free from old rules. It was a strategic decision aimed at ensuring long-term stability and growth in an uncertain world. To truly grasp the shockwaves rippling through today's global economy, we need to journey back to the turbulent 1970s, a decade marked by political upheaval, economic uncertainty, and dramatic shifts in world power. In 1971, President Nixon made a historic decision. He severed the dollar's link to gold, ending the Bretton Woods system. Almost immediately, the world was rocked by the OPEC oil embargo, which sent oil prices skyrocketing and left nations scrambling for energy. Amid this chaos, the United States and Saudi Arabia forged a pivotal alliance. The deal was simple but powerful. The US would provide military protection and advanced weaponry, while Saudi Arabia agreed to price its oil exclusively in US dollars. This arrangement meant that Saudi petrodollars, profits from oil sales, were recycled back into the US economy, especially into US government debt, fueling a massive and sustained global demand for the dollar. The petrodollar system cemented the dollar's status as the world's reserve currency, granting America what French officials famously called an exorbitant privilege: the unique ability to print money that everyone else needed. With this privilege, the US could run persistent deficits, borrow at low interest rates, and exert enormous influence over global finance, shaping the world's economic order to its advantage. For Saudi Arabia, the benefits were equally transformative. The kingdom gained not only immense wealth but also security guarantees from the world's most powerful military, solidifying its position as a regional powerhouse. This alliance spurred rapid development in Saudi Arabia, turning desert cities into modern metropolises, while giving the US a powerful lever over global energy markets and international politics. For decades, the petrodollar system defined global finance, creating a stable, if unequal, order that underpinned prosperity for some and dependency for others. Every nation that needed oil had to acquire dollars, effectively supporting the US financial system, whether they liked it or not. This gave America unparalleled economic reach. The arrangement was mutually beneficial, but it also entrenched American dominance and shaped the geopolitics of the modern era. Over time, this system bred both extraordinary prosperity and deep resentment, fueling both economic booms and political backlash across the globe. Now, for the first time in generations, we are witnessing the first true crack in that once unshakable foundation, a moment that could redefine the future of global finance. The petrodollar system powered American global leadership. Dollar demand kept U.S. borrowing costs low and allowed Washington to finance vast programs by printing money. The dollar became a tool of foreign policy, especially sanctions, which could isolate adversaries without military force. But this privilege came with costs. A strong dollar hurt U.S. exports and hollowed out manufacturing. Persistent trade deficits and economic imbalances grew. For other nations, dollar dependence meant vulnerability to U.S. policy and financial shocks. Major economies like China and the EU grew uneasy, holding vast reserves exposed to U.S. politics. The system was stable but deeply unequal, fueling a global desire for alternatives. The petrodollar's power was both a blessing and a burden. The petrodollar's decline began with the very power it gave the U.S. Washington's use of sanctions alarmed both allies and rivals, prompting moves to de-dollarize. Russia and China increased trade in their own currencies and built alternatives to SWIFT. The 2008 financial crisis, born in the U.S., exposed the fragility of the dollar-based system. Calls for a multi-currency reserve system grew louder. U.S. military retrenchment and the shale oil boom shifted Middle East dynamics. Saudi Arabia questioned America's reliability, while China filled the vacuum. Iran and Venezuela traded oil in other currencies, but the real threat was a major OPEC player breaking ranks. Whispers of such a move grew as frustration with U.S. policy and China's economic rise converged. The stage was set for a dramatic shift. The foundation was cracking, and the world was watching. Saudi Arabia's pivot to the yuan was a strategic calculation, not a rash decision. U.S.-Saudi ties had frayed, especially after Trump's unpredictable policies and tepid responses to regional threats. Riyadh realized it could no longer rely solely on Washington for security. Vision 2030 demanded new partners and investment. China fit the bill perfectly. China's Belt and Road Initiative and technological prowess made it indispensable to Saudi ambitions. As China became Saudi's top oil customer, the logic of accepting yuan grew irresistible. The move cemented a vital partnership and signaled Saudi Arabia's strategic autonomy. It was a bold message. The kingdom had options beyond the U.S. China's victory was decades in the making. Reliance on the dollar for energy was a strategic vulnerability Beijing was determined to fix. China internationalized the yuan, launched its own oil futures, and used its market power to push suppliers toward yuan transactions. With massive investments in Saudi Arabia's Vision 2030, China became more than a customer. It became a partner in the kingdom's future. Chinese firms built infrastructure, technology, and renewable projects, embedding themselves in Saudi growth. Unlike the US, China offered partnership without political lectures, focusing on mutual benefit. This deep integration made accepting the yuan a logical next step. The alliance was now economic, technological, and strategic. For China, it was a masterstroke, challenging the dollar's dominance from within the system. The Saudi announcement triggered a global scramble, sending shockwaves through financial centers and newsrooms around the world. Analysts and journalists rushed to interpret the implications as uncertainty rippled across continents. Oil prices jumped sharply, then stabilized after initial panic. Currency markets were rocked by volatility and speculation. Traders scrambled to adjust their positions, unsure of what would come next. The dollar weakened noticeably, while the yuan surged in value, reflecting shifting confidence. Central banks worldwide faced tough choices about their reserves, debating whether to stick with the dollar or diversify into other currencies. Some, like Japan and Taiwan, watched nervously as their vast dollar holdings lost value overnight, raising concerns about the stability of their own economies and financial systems. The debate over diversifying reserves intensified, with experts warning of a self-reinforcing cycle against the dollar. As more countries considered alternatives, the pressure on the dollar only grew. Governments issued cautious statements, trying to calm markets. Russia openly cheered the move, seeing an opportunity to weaken U.S. influence, while the EU hinted at a bigger role for the euro in global trade. Developing nations quietly welcomed what they saw as a potential shield from U.S. sanctions, hoping for greater independence and flexibility in their international dealings. The G7 called an emergency meeting, underscoring the gravity of the shift and the urgent need for coordinated action among the world's largest economies. The world now faces deep uncertainty. Will other oil producers follow Saudi Arabia's lead, or will they hold back and wait to see the consequences unfold? If so, the petrodollar system, which has underpinned global finance for decades, could unravel quickly, changing the rules of international trade and investment. Risks include financial instability, sudden capital flows, and unpredictable market reactions. There's also a chance for a more balanced multi-currency world, where power is more evenly distributed. The era of dollar dominance is ending, and with it, the certainty that has defined global finance for generations. We are entering a new, unpredictable financial age, one filled with both risks and opportunities, as the world adapts to a rapidly changing economic landscape.